invested in. And then the same question usually, why are you investing?
Okay.
Because you could invest to own a home. So when you invest to own, it's still an investment because your home is what you look at it as. Then you can also invest for investment purposes, so it's a return. So with 2 million, you could invest somewhere in Ogun State or in Enugu State, and you buy a 3-bedroom apartment or a mini flat. So you buy, in Ogun State, you buy a mini flat, 2 million, and you don't plan to stay there, but you'll be getting capital appreciation and rental returns.
Okay.
And so with that, your investment is growing.
Okay.
But coming back to the first area, which is the most important thing, the capital available. In Nigeria today, an average 21-year-old is a young school leaver who has a maximum of 1 year or so work experience. So the average salary for that kind of person is somewhere between 50 and 80,000. So at 50 and 80,000, if the person is highly disciplined, which sometimes the economy does not encourage that because there are so many emergencies that comes up.
Yes.
But let's assume all things being equal, the person should be able to put 35% of his income down for investment. But facing the realities on ground, I would push it to 25%, while 10% is for emergencies.
Okay.
So at that level, still in 5 years' time, the person should have been able to generate a reasonable volume of investments that would have gotten to somewhere in the range of that to, if possible, 5 million.
Okay.
But what I usually advise is the first investment you should make is investment in yourself. Don't go into an investment you don't know much about. Because that's the first rule of failure in investment. When you don't know anything, you just say, oh, what investment is selling now? Oh, stocks. Okay, buy me stocks. Why are you buying a particular stock? When and what is it about? You need to first invest in yourself. Find out what does it mean to invest in the stock market? Why do people invest? What are the kind of returns? What are the kind of stocks? Those are basic knowledge. Why this kind of stock? What are the kinds of returns? Not, oh, if I invest 100,000, I'll make 100,000. So going to know why, what do you do to get, what kind of returns exist in the stock market? Yeah. And so when you know that, it's always advisable you work with your stockbroker. The stockbroker says, oh, there's a stock coming up with 100,000 we can invest, and it's the minimum expected is 20% returns in the next 12 months. You say, okay, yes, that's good, but on what basis did you come up with this analysis, and why, and what? Because also there are some stocks based on your personality now, you might not want to invest in it.
Okay.
Looking at issues,
high risk.
No, not even high risk. Issues of religion.
Okay.
Issues of personality. There are some stocks. Some people will now find out that they do a lot of. They are not against violence to women or underage labor. Okay. And you might have a personal issue against that. So when your stockbroker tells you it's this company and you have that information, if you didn't arm yourself, you won't be able to do that. And it goes against you when you go out there and say, oh, I do not support violence against women, against women. Then somebody comes and says, but you see, there is a company you invested in. And you go out and say you don't know. Then what are you saying? So those things come to play in which company you invest in and why. Okay. That's why some people will never buy tobacco stocks, no matter how lucrative it is because of their personal beliefs. So those things come to play. But the only way you can play in that to become an intelligent investor is having such information. So the first investment you make is on yourself, by arming yourself with information that gives you knowledge to know why and where you invest. You can never be the superstar. So what you do is, over the next 5 years or thereabout that you're investing, do it along with your investor. Let your investor always educate you on which stock and why and what and when. And then if he tells you are going to make 20% returns, in what area? Is it appreciation? Is it dividends? Is it bonus? What is it? So that doing that regularly over a 5-year period, you become as good as you won't know the tiny numbers that actually save you or destroy you, but you have a general knowledge and always arm yourself with general financial information, because at the end of the day, your investment is fighting with inflation. Your investment is fighting with unemployment. Your investment is fighting with the GDP. A good investment should beat all these indices at every point in time. So when it does that, you are doing well.
So that's how you calculate your risk and your profits and all that. Okay. So I'm still very much interested in knowing what an investment plan looks like for someone who's 50 or above.
Yes, we're still on the 30-year-old. So like I said, 20, 30-year-old long-term, minimum, medium term. When you now get to somewhere around 40, you are heading towards settling down. When I say settling down, that is you are planning towards retirement, not marrying.
Of course.
No, some people marry at 40. After all, life begins at 40.
But the general perception is to get married earlier than that.
Yes. So at 40, you're planning towards settling down. So you now start focusing more on the short-term investments. If you are just starting, you'll be looking at short to medium term investment that gives you returns you can see. Why? At that point, you need to see your money so that you know what you have for retirement.
Yes.
And so, yes, still invest in bonds, stock, but at the same time, still invest in real estate. I expect at 40, you would have had some savings, and those savings would have been a reasonable amount, 1, 2, 3, 4 million, thereabout, which allows you still play to some extent in the real estate. And investment sometimes is not just you alone. You could decide to gather 4, 5, 6, 7, 10 of your friends together, and you pull your savings together and invest. And investment is not just the stock market, the real estate. It's also investing in other businesses or investing in a cause that you feel you should support. Like I said, violence against women, supporting those against underage labor and all that. It's still an investment that you have a expected return. So you could get your friends together that you share the same vision and say, look, we need to get a portfolio and grow it to 100 million and share the returns. It might be 4 of you. So at the end of the day, you have 25 million each. We need to do that in the next 10 years because it adds to your retirement savings. So automatically, what do? Each of you could come up with 5 million each. You put it down, and that gives you 20 million. So in 10 years' time means it must give you a minimum of 10% returns every year to have 100 million. So you look at the investment options available. For example, for now in Nigeria, putting your money in a fixed deposit is about 9%. So it's not bad. It's just that you're just below that. So you could go into that as an investment option. Stock market still gives you up to 20%. So you go into that, it's good for you because in 5 years' time, you've made your money. Yes, instead of the fixed deposit. Then it's, but if you're a risk-averse person, stock market is a risky market. It's a 50-50 thing. So you might not want to go there. If you still want to play in the capital market, then you can decide to buy bonds instead, which is guaranteed. That's government bonds. Because they are private bonds also.
Okay.
So but government bonds are guaranteed by the country. The only time you'll not get value on your investment is if the government goes out of existence. But as long as they are still there, then your 20% is your 20%, which is good. So you could decide to go there. But when you now have a higher pool of funds, like you're a group of friends that came together, then you could invest in real estate. Because real estate is capital intensive. But with a 20 million, you could still get like a 3-bedroom flat in Lagos, in some parts of Lagos, or you could go out and get a duplex somewhere, and then the rental income plus the capital appreciation works for you. At that point, when you're an investor, you need to set sentiments apart. For example, it might be a lovely house, and you might have rented it to your friend. So your friend might decide, because you are my friend, I have your rent, but I have an investment I want to make somewhere. So I'll delay your rent. That money is planned for. So,
yeah, of course.
That money is planned for. So I need my rent. You are my friend or not.
Yeah.
So you don't bring friendship into such. You have to take out sentiment. Then you might like the house and where it is, so much love it that when it's time to sell, to gather your pool of funds for a bigger and better investment, you don't bring in sentiments and
maybe I should just live in this house instead.
Oh no, that place is lovely. Whenever I tell people I have a property there, they it's so, but no.
Yeah, selling when it has that value.
It has given you probably a 200% return in the last 5 years. So your 20 million is now 60 million. You now have the opportunity to, it might be a trading opportunity where you put 60 million into a portfolio, and in 2 years it will give you 100 million. But you are still thinking about your house because it's in a lovely location.
I don't want to lose it.
That's investment. You have to take out sentiment.
Okay.
Do that, because when you make your 100 million, you can come back and take 60 million and buy
it.
Probably a newer one then, because your house is now old at 5 years.
Okay, yes, that's true.
So those are the things. So, but when you are 40, those are the things you look at. Things that you can give you short-term returns. Yeah. Then when you get to 50, you are now somewhere around retirement. So at that time, you are very conservative and you are risk averse, because you might lose everything when you are less risk averse. So it's returns that probably you put your money in fixed deposits, you put your money in a guaranteed bond, or you put your money in commodities you are sure of, like gold.
Okay.
Like precious metals. But you will not put it in things like farm produce.
Why not? Can't you can't you have like a farm and then you invest and then you get your returns, or just invest in someone else's farm business and then get your returns when they sell? Because food will always sell. Isn't that the logic?
Food is a necessity. If it's a business, if you're investing it now as a business, I mean, you're investing in a business, it's fine.
Okay.
But you look at it's a risk return thing.
Okay.
Farm has a lot of risk. For example, what if there's a flood?
Okay.
And you invested in it,
okay, and
the farm was not insured.
Okay.
What happens?
Okay.
At 50, you can't cry when it happens. When you're 20, you will cry and cry and cry your heart out, then pick up the pieces and start again. Yes. But at 50, you will get a heart attack. Do you understand?
Okay, so I get that now.
So that's why you will not advisably invest in a farm produce. And even when you are doing that, they will tell you, make sure it's insured. And when it's insured, you find out which insurance company. Is it the type that pays on time? Or is it the type that doesn't pay? Or is it the type that stories start coming in? And so it might take you another 1 year to get your investment back, yes, which inflation would have eaten whatever they give you back. So those are issues you look at before you go into that. So the risk is high. But you go for safer stocks, which usually, we are not there yet in Nigeria, but you can now invest in futures.
Okay.
Future stocks, or you invest in guaranteed investment at 50, like FX. You can now trade in foreign stocks, the foreign markets, because there the economy is more stable and you can predict more with you get.
Yes.
Because it's your money.
Okay.
And your life is at stake.
So when you mentioned Forex, the first thing that came to my head was the image of someone crying, a young person actually, who invested in Forex, and in one fell swoop, I don't know what happened, market crashed, and that was it. So if a 50-year-old would probably get a heart attack from losing their investment to a flood in farm produce example, what gives us the assurance that a 50-year-old will not have the same heart attack if something happens and the stock market crashes in Forex trading, for instance? I mean, how safe is that? Is that not very risky?
You see, there is no investment that is safe. I repeat, there is no investment that is safe.
Okay.
But there are a lot of investments that are guaranteed. There's a difference between safety and guarantee. So, starting from the stock market, more often than not, people lose due to greed and poor market knowledge. Those are the two things.
Okay.
You need to have your market knowledge, and then you need to control your greed. When you have market knowledge, you know at this point in time you can't invest in this sector or this sector because there's a lull in the market, or looking at this particular company, they might go into a loss, which means you won't get dividends, or or they are not doing too well, or looking at their dividend history is not so good. Based, and all your investment, you always use it to compare inflation, GDP growth, and all that in the economy.
Okay.
Because if not, you thought you made money, but when you now look at the returns, actual returns is not money. Profitable. So you look at all that. But now, when you now look at FX too, that's why I said, first of all, make sure you have knowledge. Okay. You don't go into an investment, you don't know much about it. Then when you go into it, you set a cap. This is my maximum, this is my minimum. There are now automated systems that helps with that. Okay. So it is when you see your maximum has been exceeded and is still going, what is now your risk and greed level?
Okay.
Which is where you can either make it or might.
Okay.
Yes, and it's I see FX as playing cards. When you play cards, the first thing you do is take your money out as you win from your winnings. Okay. So when your money is out and is safe, you are now playing with the house money. Okay. No, you're playing with the house money. So with the house money, you don't lose.
Okay.
You don't lose.
Because it's really not your money. It's
not your money. Whatever you now do, it's now about your risk appetite and how much you want to make.
So you're saying that anyone who trades in Forex, for instance, if your cap is $150,000 or something, and you've gotten to that point, but a lot of people want to push their luck and say, what if I get more than this? So you're saying that if your investment really, if you put in maybe 50,000, by the time you hit 150, pull out your 50,000 and hold on to it, and then continue to trade with.
Yes, put the 50,000 somewhere else. Okay. So you know you are safe. Okay. No matter what happens, you have your 50,000 to start again.
Okay.
So then you can now decide to grow the 50,000. Where am I going to? You made 150. You took out 50,000. You have 100. The 100 now you start with 50, so the 100 grows to another 300. Take out 100 and put it somewhere else. Another investment. That's you are growing. You are diversifying your portfolio, so that the day FX fails you,
you still have
that. Probably by that time is 300. So cry. It's always good. Then wipe your tears and move on.
And then start again.
Yes.
All right, so on a final note, where does cryptocurrency fit in all of this conversation, and how safe is it?
I will still start from where I stopped. No investment is safe. Okay. But some are now more riskier than some.
Others. Okay.
So, and that's where cryptocurrency falls in. For free, I will tell you that cryptocurrency, for now, the returns are good, although they lost a lot of money last week.
Yes, last week was good. Red.
But it's an unstable currency, it's volatile, it's uncontrolled. So those are the risk factors. What is your risk appetite? Don't look at just the returns. You always look at returns and risk. So if your risk appetite, you are the 50-year-old, 60-year-old, please, it is free money. Money you can do without, you put in crypto. But if not, please avoid it. That's the truth. Because the prediction sounds good. But even the predictions are conservative, and they always remind you that it is volatile. So, and that's what I would say too. It's good, and at the same time, it's dangerous. It's good, and at the same time, it's dangerous. Okay. So it's up to you to decide, because there is no investment. I tell people there's no investment I'll tell you not to invest in. It's about your risk appetite and capital you have available, and why you have that much. Okay. Because sometimes somebody might come and say, Yemisi, I have this 10 million. I'm going to leave it with you. Please keep it for me for the next 1 year. I'm traveling. When I come back, I will take it for you. That's hot money, as they say. And when you have hot money, don't put it in hot investment. You need to balance it. Yeah. You get so those are that's what I mean. Okay. You need to balance it. Those kind of money, the highest I expect you to do is put it in like fixed deposits at 9%. 9% on 10 million is not bad for money that wasn't yours.
Yours to start with. Okay. Thank you so much.
Thank you very much.
Was a conversation on making the right investment choice with Ayo Emma Hiome.